Let's get back to the broader markets, talking about where we ended last year, what that could mean for this year. Joining us is Katie Stockton, founder and managing partner at Fairlead Strategies, as well as a CNBC contributor. I guess there's some things on the calendar that technicians pay attention to, but in general, I would imagine there are overriding factors that have nothing to do with what month it is or what year it is. So has anything really changed since last time you were on, Katie, in terms of looking for, I don't know, more sideways activity with potentially testing the lows with across the board in stocks and bonds and crypto?
Yeah, we've really seen no improvement relative to our last discussion. We were looking for some firmness into year end, and that was based in part on the so-called Santa Claus rally, which is actually still in force today and tomorrow. So we expect more firmness this week, after which I think we can see volatility pick up to the downside. And we're watching the VIX, for one, very closely. If you look at the VIX, it's testing its 50-day moving average. A breakout above that 50-day moving average would suggest that it has room to next resistance of roughly 35. And you can imagine what that might mean for the inversely related S&P 500. We're watching for the S&P 500 right now some support around 3,800, which does appear in jeopardy of breaking, maybe not this week, but perhaps even next week. And then, of course, we set our sights back on that 3,500 level. So we're looking for even a volatility event potentially this month into next month, and we'd be managing risk accordingly. The seasonal influences are sort of petering off here, in terms of that Santa Claus rally. So we're losing that tailwind.
So in terms of percentages, it must be a lot more likely that we see new lows than we see new highs this year. So what would be the percentage, in your view, probability that we see new lows? Just take the S&P, and what's the probability we see new highs in the S&P? You can't say never for new highs in the S&P. Do you think it's twice as likely we see new lows as new highs?
Oh, yeah, I think at least that. I think new lows are highly likely, maybe 80-20 if I had to assign a percentage. And new highs are not likely this year, but perhaps next year. I do expect this year to be an inflection year, and that makes it really hard to predict where we might see the S&P 500 at year end. But we do look for some kind of major low to be established on the back of a volatility event. We don't have the long-term positive divergences that we look for to signify that major low as of yet, but that is something that we could see perhaps in the coming months, maybe the next 4 to 6 months. We think that is pretty likely. So remember, the market's looking forward, looking past the recession.
So we don't get positive divergences that you're looking for from sideways activity. You're talking about some type of move to lower levels that would set up for positive divergences that could then have a sustained uptrend associated with it. So no matter how you look at it, you're looking for more trouble ahead?
I mean, it could be sideways action. I think it's less likely, though, because I do think that the market needs that kind of capitulation that tends to be associated with bear market lows. Corrective lows don't always see it, but bear market lows pretty much always do. So I think we need that volatility event. We need the VIX perhaps even closer to 50 before we can really get out of this downtrending mode. The long-term momentum is still very much to the downside. And unfortunately, after December's 6% decline in the S&P 500, that also means intermediate-term momentum has deteriorated as well. And the short-term oversold condition really only has shelf life for perhaps the next week or so. And once you remove that tailwind, of course, then the risk is greater to the downside. We've seen very defensive sector positioning, of course, value over growth. None of that appears to be changing to us as of yet. The uptrends in the ratios of consumer staples, healthcare, utilities, you name it, they're all in uptrends versus the S&P 500, and those trends still look very much in force. And we'd expect it to remain the case until we get out of this bear market cycle, after which we'd look for technology and consumer discretionary to reassert themselves. But with Apple, the leader within the technology sector, breaking down, that of course kind of sets that back another potential couple months.